Macroeconomics looks at the big forces: inflation, economic growth, unemployment, interest rates, government spending, and currencies. These aren't daily news stories. These are decade-long tidal waves that reshape your wealth, your job security, and your quality of life, whether you're paying attention or not. The scary part? Most people aren't paying attention. The exciting part? You're about to.
Quick question, and be honest. When you heard inflation went up 6% this year on the news, did you actually know what that meant for your life? Or did it just sound like a number? Most people nod along, but there's a massive difference between hearing a statistic and understanding what it does to your bank account, your investments, your future. That gap between knowing and understanding is exactly what this video closes. Keep watching.
Here's the single most important idea in all of macroeconomics. Everything is connected. Think about it like this. A company builds a product. It pays workers wages. Workers take those wages and spend them on food, rent, Netflix. That spending becomes revenue for other businesses. Those businesses hire more workers, and the loop continues. This is called the circular flow of the economy. Money constantly moving in circles between households, businesses, and governments. Now here's where it gets critical for you as an investor. When one part of this loop slows down, the entire system shakes. If companies stop hiring, people earn less, they spend less, companies make less revenue, they cut more jobs. You've seen this happen. 2008, 2020, it always starts with one domino. The question is, can you see the domino before it falls? That's what macro knowledge gives you, the ability to spot the early warning signs before the headlines do.
Let me tell you something that should make you uncomfortable. If you have money sitting in a savings account earning 1% interest and inflation is running at 4%, you are losing money. Not losing it in the dramatic stock crash way, losing it silently, invisibly, every single day. Inflation means prices keep rising over time, which means every dollar, every rupee, every pound you hold buys slightly less than it did before. Here's the distinction almost nobody explains. A single price going up is not inflation. If oil spikes for 3 months and then drops, that's a price shock. Inflation is when the overall level of prices keeps marching upward year after year. And here's why it matters for investors specifically. Official inflation numbers are averages. If you spend heavily on rent and food, two of the fastest rising categories in most countries right now, your personal inflation rate is almost certainly higher than what the government reports. You're not imagining that things feel more expensive. You're right. And now you know why.
Here's a psychological trap most people fall into. They think inflation only hurts poor people. Wrong. Inflation is an equal opportunity wealth destroyer. It just destroys it quietly in ways that don't make headlines. The person who feels financially safe with $50,000 in cash, after 10 years of 5% annual inflation, that $50,000 only has the buying power of roughly $30,600. They didn't lose money, but they lost over $19,000 in real value, and they did absolutely nothing wrong except hold cash. Understanding inflation isn't academic, it's self-defense. Let that sink in for a second.
So where does inflation actually come from? There are 4 engines that drive it, and smart investors watch all 4 at the same time. First, demand-side inflation. The economy is booming, people have jobs and confidence, everyone's spending, but the economy can't produce fast enough to meet demand, so prices rise. Think of a sold-out concert. More buyers than tickets means higher prices. Second, supply-side inflation. This one is sneakier. Production gets disrupted, energy prices spike, supply chains break, labor shortages hit, and companies raise prices just to survive. You saw this play out in real time during and after COVID-19. Third, monetary inflation. When central banks print money faster than the economy produces real value, each unit of currency becomes worth less. More money chasing the same goods equals higher prices. Fourth, and this one is the most underrated,
expectation inflation. If workers believe prices will rise, they demand higher wages today. If businesses believe costs will rise, they raise prices today. Belief alone can create the very inflation people feared. It becomes a self-fulfilling prophecy. When you're investing, watch what people expect, not just what's currently happening. Here's a question worth pausing on. Which type of inflation do you think is hardest to stop, and why? Drop your answer in the comments below. I'll reply to the most interesting ones. Think about it. Demand inflation just needs people to spend less. Supply inflation needs production to recover. Monetary inflation needs policy discipline. But expectation inflation? That requires changing what millions of people believe about the future. Once inflation gets into people's psychology, once it becomes expected, it's nearly impossible to kill without causing real economic pain. That's why central banks obsess over managing expectations, not just data. One of the most powerful forces in economics isn't a number, it's a feeling. Now, let's talk about the player with the biggest budget of all, the government. Governments spend on healthcare, education, defense, infrastructure, pensions, and more. When they spend more money than they collect in taxes, that gap is called a deficit. When they collect more than they spend, it's a surplus. Here's what most people miss. Deficits are a tool, not automatically a problem. During a recession, when private spending collapses, the government can step in, increase spending, and prevent a freefall. This is called expansionary fiscal policy. Basically, the government deliberately running a deficit to keep the economy from crashing harder. But, and this is a critical but, when governments run large deficits for years without a plan, debt piles up. Interest payments on that debt start eating into the budget. Eventually, it crowds out spending on education, hospitals, infrastructure, the very things that drive long-term growth. For investors, the key question is never just, is this country running a deficit? The real question is, at what point does the debt become unsustainable? That's where sovereign debt crises begin, and they hit investors hard. If governments are the economy's lawmakers, central banks are its engineers. The Federal Reserve, the European Central Bank, the Bank of England. These institutions don't compete for votes. They don't answer to election cycles. They have one mission above all else: keep prices stable. Their most powerful tool? The interest rate. When inflation is running hot, central banks raise rates. Borrowing gets expensive. People take fewer loans. Businesses invest less. Spending slows down. Inflation cools, but so does growth, and that can tip into recession. When the economy is sluggish, central banks cut rates. Borrowing becomes cheap. People and businesses spend and invest more. Growth picks up, but held too long, it can reignite inflation. This is the tightrope walk that central banks perform constantly. As an investor, this matters enormously. Low interest rates push money into stocks and real estate because bonds look boring by comparison. High interest rates pull money back into bonds. Understanding where rates are headed, even directionally, gives you a massive edge in positioning your portfolio. Let me say something that most financial commentators won't. Every single major market crash in modern history had macroeconomic warning signs before it happened. Before 2008, interest rates were rising, the housing market was overheating, and debt levels were unsustainable. Before the dot-com crash, valuations had completely disconnected from economic reality. Before the 2022 correction, inflation was spiking, and the Fed had signaled aggressive rate hikes. None of these were secrets. The information was there. What most investors lacked wasn't access to data. It was the macroeconomic framework to understand what that data meant. That framework is what you're building right now. Don't skip the next section. Here's where macroeconomics starts to go global and where it directly hits your portfolio if you hold any international assets. Exchange rates determine how much one currency is worth compared to another, and they don't move randomly. They're driven by supply and demand, powered by trade, investment flows, inflation differentials, and interest rate differences.
If a country is growing fast and attracting foreign investment, demand for its currency rises and it strengthens. If a country has high inflation or political instability, investors flee and the currency weakens. Now here's the investor-critical insight. Capital flows follow returns. If one country offers 6% interest on bonds and another offers 1%, money will move, and quickly. That movement affects currency values, stock markets, and commodity prices all at once. There's also the concept of foreign reserves, the foreign assets a central bank holds as a safety net. A country with thin reserves and a weakening currency is in a vulnerable position. This is often a leading indicator of a currency or economic crisis. When you invest internationally, you're not just betting on a company or an economy, you're betting on a currency too.
GDP, gross domestic product, is the scoreboard of an economy. It measures the total value of everything produced inside a country's borders in a given period. But here's what most people get wrong. GDP growth alone doesn't tell the full story. Nominal GDP can rise simply because prices rose, even if actual production stayed flat. That's why investors track real GDP, which strips out inflation to show true economic growth. Even more useful is GDP per capita, GDP divided by population. Two countries can have identical GDP totals, but if one has twice the population, its average citizen is producing and earning far less. Now layer in the business cycle. Economies don't grow in a straight line. They expand, slow, contract, and recover over and over. Expansion brings jobs and rising incomes. Slowdowns breed caution. Recessions, technically 2 consecutive quarters of contraction, bring unemployment, falling confidence, and real pain. For investors, the game is to identify where in the business cycle an economy currently sits. Are we in early expansion, late cycle heat, early contraction? Each phase historically favors different assets, and knowing the cycle is one of the most underused edges in investing. Every country that borrows money carries a level of risk, and investors price that risk constantly. The key concept is debt sustainability. Can a country keep paying what it owes without spiraling further into debt? The math is brutal in its simplicity. If your debt grows faster than your economy, you're heading toward a crisis. Imagine a country growing at 2% per year but paying 8% interest on its debt. Every year, the hole gets deeper. At some point, investors stop buying that country's bonds unless they're offered a higher return to compensate for the risk. That higher return is called the risk premium. Watch this number. When a country's risk premium spikes, when investors suddenly demand 5%, 6%, 7% more than what the U.S. pays, that's the market saying, we don't fully trust this country to pay us back. Currency also reacts to this. A higher-risk country sees its currency weaken, which makes its foreign debt even harder to repay, because it now owes dollars while earning less valuable local currency. For emerging market investors especially, monitoring country risk isn't optional. It's the foundation.
Okay, real talk. How many of these concepts did your school teach you? If you're like most people, the answer is somewhere between barely and none. And yet, every single one of these forces, inflation, interest rates, GDP cycles, currency movements, sovereign debt, these things affect your financial life every single week. Here's a challenge. Go check the latest inflation report for your country this week. Look at whether your central bank recently raised or cut rates. Look at how your currency has moved against the dollar in the past year. You'll see everything we've covered today playing out in real time. That's the shift macroeconomics creates. The news stops being noise. It starts being information you actually know how to use. You've got the framework now. Time to apply it. So how do you actually use all of this as an investor? Start with the economic calendar. Every week, key data is released. Inflation reports, GDP numbers, unemployment figures, central bank decisions.
These aren't just news. They are the inputs that move markets, shift interest rate expectations, and reprice entire asset classes. When inflation comes in higher than expected, the market reprices interest rate hikes, bonds fall, growth stocks get hit, commodities often rise. When GDP beats expectations, risk appetite grows. When unemployment spikes unexpectedly, defensive assets tend to outperform. The goal isn't to predict the future with certainty. No one can do that. The goal is to understand the environment your investments are living in and position accordingly. In an inflationary environment, cash loses value. Hard assets, commodities, and inflation-protected bonds tend to hold up better. In a rising rate environment, long-duration bonds suffer. Financials can benefit. In a recession, defensive sectors, utilities, healthcare, consumer staples historically outperform. Macroeconomics doesn't tell you what to buy. It tells you what kind of world your money is walking into. That context is worth more than any single stock tip.
And there it is. From the circular flow of money to inflation psychology. From central bank interest rate decisions to sovereign debt risk premiums. From business cycles to building a macro framework you can actually use. Macroeconomics isn't something that happens to economists in textbooks. It's happening to you right now in your grocery bill, your mortgage rate, your investment portfolio. The difference between investors who thrive in volatile times and those who get wiped out isn't usually intelligence or luck, it's context. It's the ability to look at the world and understand why things are moving the way they are. You now have that context. If this video helped you see the world differently, hit like. Subscribe if you want to keep building this kind of investing knowledge together. And comment below. What was the one concept in this video that surprised you the most? I read every single one. See you in the next one.